I'm Mary Lyons, the Wealth Woman.
And I'm Eric Alexander with Acorn Grove.
Welcome to the Wealth and Income Podcast. Today has been an exciting day in the market, to say the least, as we are recording this.
Yes.
We are doing this recording on Monday, April 7th, and this comes after two very scary days in the market and a very bouncy day today.
Yeah, it's spicy.
It's spicy. I like that. Well, I don't actually like it at all, let's be honest, but I like the description. So what I think is kind of key to know here is that what happened Thursday and Friday is the worst market loss since March of 2020.
Yeah,
which
it was a rough day.
Yeah. So I think it's worth looking at and kind of talking about what's happening, because I think one of the things that I see is that environments like this tend to be really good at compounding fear. So compound interest, good; compound fear, bad.
Not so good.
Not so good. But I think really talking about what happens if the market goes into a free fall is important. That way you know where there might be some stop gaps. And then we're going to talk about it at the market level, at the portfolio level, at a strategic plan level. We're going to go all over the map today.
At the emotional level.
At the emotional level. Yeah, I like that you're the one bringing that up. I feel like it's usually me.
I know. I'm evolving somehow.
Well, or you're becoming more emotionally volatile. I don't know. I'm rubbing off on you.
Well, that's not wrong.
So let's talk about what happened. So the S&P actually has a circuit breaker built into it, I guess is the way to say it. If the market were to lose 7% over the course of the day, and that happens before 3:25 Eastern time, there is an automatic 15-minute halt to trading so that people don't go into a panic spiral and just keep selling because everyone...
The run on the bank, basically.
Yes, exactly. If that same 7% loss over the course of the day happens after 3:25 Eastern, then they actually just suspend trading for the rest of the day, which is all of 35 minutes.
Yeah, market closes at 4, so it's not a ton of time, but let's just be done. Everybody go home.
Yeah, go home, sleep it off. And then the next kind of point where it would happen again is if losses total 13%. So if losses total 13% and we are still again before the 3:25 time period, then it will shut it down for 15 minutes.
So total at that point would be 30 minutes of a pause.
Correct.
In two different chunks.
Then if that 13% loss happens after 3:25, again, they just suspend trading for the rest of the day. And then here comes the next one, the doozy. If the market loses 20% over the course of one day, then trading is suspended for the rest of the day. And all of this is to give people time and space to sort of wrangle their emotions.
Yeah, well, and for some other data to creep in, because I think once you get into a feeding frenzy, it's hard to get out of it because we talk a lot about this idea of the elephant and the rider. Your neocortex, your thinking brain is disconnected at that point. You're just in fight or flight. You're in reptilian brain mode. So choices are not usually positive in that framework.
Right. It's all
fear. If you're running from a bear, it's a great choice. If you're running from the market, not a very good place to be.
Well, and I think this is interesting. I'm going to read a quote here that is from Warren Buffett because I think it's particularly applicable here. And it's actually not from him at all. It's from a poem written by Rudyard Kipling. But Warren Buffett stuck it into a shareholder newsletter that he sent out in 2017. And I feel like it's so applicable right now. So in that newsletter, he stressed the importance of sticking to a long-term strategy, regardless of how market volatility is impacting you emotionally in the moment. So what he kind of put in there, the part of the poem that I think is particularly notable is this. If you can keep your head when all about you are losing theirs, if you can wait and not be tired by waiting, if you can think and not make thoughts your aim, if you can trust yourself when all men doubt you, yours is the earth and everything that's in it. And I think this goes to exactly what you said about the elephant and the rider. And for those of you that aren't familiar with that particular story or parable, is the idea that emotions are the elephant and logical behavior or logical thought is the rider. And so if you think about a normal day to day, if someone is riding an elephant that has been trained, they can steer and guide and turn and control what's happening with the elephant. But the moment the elephant is triggered and goes into stampede mode or fear frenzy, there is nothing that rider can do except hold on tight and wait for the elephant to calm down. And I think this is how, whether we want to admit it or not, this is how most of us are impacted. When we are triggered, when we are emotional, we think we are making logical decisions, but we're actually making emotional decisions that we often regret after the fact. And so I think having a plan of action for how you are going to deal with things ahead of time is key. Knowing that, yes, there are some breaks that can be pulled in the market is helpful. But I think going beyond that into portfolio management and then into strategy management will help with the emotional management. So, Eric, do you want to talk a little bit about what should be happening in the space of portfolio management to control fear?
Yeah, and I think a lot of it is the stuff that you do when you're in a rational state so that you prepare for the moments when you're not. And, level one of that, I think, is just asset diversity. We want some bonds and some stocks. So we want some different sectors. We want things like alternatives built in there or commodities. We want to really spread out that risk so that there's no one component of your portfolio that is derailing everything. You at least have some breaks or some cushion for the rate for the things that are going on. But bonds are in a free fall, you have equities. If equities in a free fall, you have other things.
And I think most people have heard about diversification from that perspective at
Right.
some point in their time looking at investments. You also frequently talk about diversity of style or thought management. And I think this is key as well when you start looking at these types of things so that it's not necessarily just, okay, I'm going to have these different sectors of the market, but maybe even having different approaches to those sectors can make a difference.
Yeah, and it's a long held, almost Hatfields and McCoy's sort of debate in the investment side of it of what they would call passive versus active or passive versus tactical. And like most things when we're doing it, we kind of come down the middle on that one a little bit of, yeah, passive is great because when the market's up, you get all of it. When the market's down, though, you're feeling all the bumps in the road, right? You're driving on a car with no shocks, and you're just every bump you hit, you're feeling all of it.
Mm-hmm.
And so where the tactical piece comes in is that it's a responsive design, or it's spreading out where they're doing something called a sector rotation, where maybe you want to be in energy, but then the price of gas drops to, the price of oil drops to $60 or below, which is kind of where it was flirting with on Friday. And so as it's coming down, you want to move out of that sector. You still want to be invested, but you want to change where it's going. And having some of those things that are sort of actively done, but automatic. As these things happen, we're going to start moving some things around to protect the portfolio. And so you really want to have that broad approach to diversified assets, but also diversified thought. And there's ratios in there. You don't want to have, it's probably not a good idea to have 50% active, 50% passive. There's different ratios in there that make sense, but having all of that diversity in there helps you to sort of cushion that blow. But I think the other component of it in there for me when we're working with clients is the active piece is not only just market cushion, it's the emotional cushion. Because a client knows that there's a portion of their portfolio that's automatically adjusting without them having to do anything. And it gives them a peace of mind that's like, okay, somebody's watching the ship. Somebody's keeping track of what's going on and it's happening automatically. I don't have to do anything. And a lot of times, just that space to think, that's all it is. It's just space to not get triggered or not get reactive. Helps everybody calm down for just a second to start looking at the facts and going, all right, what do we need to do? And so part of why we want to go do that is the technical pieces, but all of the emotional piece as well.
Yeah, I mean, I think every time I've ever been in an argument where something happens and I'm immediately triggered, if I take the space to breathe for a minute, my responses are infinitely better than maybe the first couple of things that jumped into my head. And it has taken me several decades, multiple decades to actually figure that out. So if we do the things with our portfolio management that allow us to take that space before we just have an impulsive response, I think that helps tremendously. So let's talk a little bit about strategy management, because this is where I get the most excited always.
That's really cool.
Is going into this is, we've spent such a long time as we've been building our career and teaching and working with our clients and really understanding these moments, like what we're going through right now in the market, have different causes every time. We don't know exactly when they're going to show up, and we don't know how long they're going to last. And so whenever you are investing, I think it is human nature to attach to the upside and potential But if you don't have a plan for how you deal with the downside, I think that's really where you take the most losses. Eric, you were showing me a really interesting chart earlier, and we talked about whether or not we were going to bring it up. And I was like, yeah, I don't think we need it. And then now I'm like, no, let's talk about it, which is typical for me.
Is this the hugs chart of the volatility
No,
chart?
no, it's the other one. So we went over this in a class we did with some of our newer advisors this morning about what happens when you miss days in the market. So I think this is particularly important just as a reminder for why you stay in through CHOP, because you don't know when the recovery is. And this is to me, I think one of the hardest things about being an advisor is that people want to know, should I get out? Should I stay in? And when you try to time the market, you often shoot yourself in the foot because it doesn't always go red to yellow to green. Sometimes it goes green to red to green and bounces around without a whole lot of signaling that it's going to do so.
Yeah. And so one of the things that they did, and this is from a company called Invesco, they put out this chart. And funny enough, these charts always come out when there's a bad day in the market, and they send this out and go, don't forget the rules, right? So what Invesco did is they did an analysis on the S&P 500 from 1994 to 2024. So a nice 30-year swath of the market and kind of what it looked like. And they said, all right, you put $100,000 in the beginning of the market, beginning of 1994. You pulled it out December of 2024. That $100,000 would have turned into 2.2 million, 2.27. So great smashing rate of return. Everybody's upside. Everybody's up. Excited about the upside, right? But they said is if you miss the 10 days, the 10 best days in that 30-year period, so whatever 10 out of 365 times 30 is, but 10 days, you would have lost almost 1.1, almost $1.2 million in growth. You went from 2.27 to basically a shade over a million, 1,040,000.
For missing 10 days.
For missing 10 days.
And this is the thing. I think that we have to remember that money behaves differently when we are growing it than when we are spending and depleting it. And I feel like I need to say that again. Money behaves differently when you are in accumulation mode than it does when you are in distribution and spending mode. So the exact same situation has a totally different result, right? If you think about what's happening right now, it is important to stay in. And also, when the market dips, if you are continuing to fund what you're hoping will eventually be your retirement, then you are buying while the market is low and supercharging your growth. And that's not to say that we're through the loss. It's entirely possible that tomorrow will look horrible or it might look better. But when you really start looking at what's happening, you can supercharge that growth and recovery by continuing to fund throughout your savings period. The exact opposite is true in retirement. Because in retirement, if you're taking a loss and then you're pulling more money out, you're actually compounding your losses. And even when the market starts to recover, if you're withdrawing the recovery, then you are keeping your portfolio from reaching its full potential again. And so same circumstances, different results for you, because in one scenario, you're putting money in and the other one, you're taking money out. And I think that's where it's easy to get confused and be like, what should I be doing? The answer is you just have to have a plan to deal with that volatility, because you don't want to miss growth while you're saving, but you need to have a plan for what you're going to do when you're spending, because this is going to happen again at some point in the future. Although it might look a little differently, the same thing is true. The market does bounce around sometimes.
Yeah. Well, and I think part of it is understanding what's triggering the market. Is it event driven or is it structural? If it's structural, okay, well, then we have to make some different choices. If it's just an event, typically events go away and people with a little bit of space. And I think that's the mantra here is with a little bit of space, the market's like, okay, we reacted. We probably overreacted. Maybe it's not as bad as we thought. Let's get back in. Mm-hmm. If it's event driven, the bumps are heavy, but the recoveries tend to be better as well. If it's structural, the recoveries are slower and you have more time to think about it. But again, I think about that structural diversification, that beyond just asset diversity, but we talk a lot about having accounts that have only growth in them. There's no downside, but having these sort of buffer accounts that have zero correlation to the market and the ability to move up when it's down isn't sexy when the market's up 24%.
Right.
It's like, why do I have this stupid account earning 3, 4, 5, 6%? Like what the heck are you people doing to me? And it's like, but wait a minute, it's not always up 12%. It's not always up 24%.
So interestingly, we had an educational meeting with somebody that we've been talking to on Thursday. So in the middle of the beginning of all of what we've experienced over the past couple of days. And we were talking about retirement, and his commentary was, it's always up and to the right, right? Like the market has done so well over the past couple of years. Why wouldn't I just put all of my money into the market and take advantage of that? And I think that's a really common way to think about things, because you look at it and you see the good years and you're like, I don't want to miss any of that. All of it needs to be in there. There's good returns over time. But the math actually shows that it is better to have accounts that are uncorrelated as well, because of how it impacts what happens in the downward trending markets like we're seeing now. So exactly to your point, Eric. And it was one of those moments where in the time you don't realize how significant the conversation is. And then a couple of days later, you're like, oh man, Eric, you sounded like a genius in that meeting, just because you're teaching the things you know, right? Which is that there are moments where the market is in a downward push. And so we don't know at this stage whether the market's going to hover where it is, whether it's going to bounce back up, or whether it's going to decide to go back down at some point. But I think having a plan in place that allows you to spend more of your money in retirement and protect your principal is key. And you have to lay the foundation for that before you get there, if you want to be efficient.
Yeah. Well, but I still think I still contend on a lot of this, though, is that there's a huge component of that structure that's not just during retirement, but it gives you, again, the space for when the world goes crazy to not overreact and try to sell it all in the dip, because you're never going to buy the bottom. Well, nobody knows when the bottom is.
And I'll speak to my own situation in this one. So we teach two strategies. We teach something called a volatility buffer. Sometimes you'll hear us call it a market shock absorber. And then we teach something that we call a simulated pension. And the way the strategy works, over time, you end up transferring roughly a third of your assets, anywhere from 25% to about 35% of your assets, into a whole life insurance policy to balance what you are doing on the investment side of things. And the thing that's fascinating about it is that there is a lot of data out there when you start looking for it. Ernst & Young did a huge study in 2022, and I heard they're actually coming out with a new one. So I'm excited to see what that looks like as well. But they proved that portfolios that include permanent life insurance and annuities outperform and create more income in retirement more than 90% of the time. And so that basically says in most cases, you're going to do better, both from an income and from a legacy standpoint. And I love that, because when I think about my own situation, knowing that I can almost double, or actually more than double, the safe spending rate for my family in retirement because I'm using those strategies, and I can do it in a way that allows me to preserve the asset base for the next generation, is tremendously exciting. And the conversations in our house this morning were, I don't even want to, so Mike, who is a longtime listener, is probably actually listening to this right now. And he kind of made the offhand comment of, I don't even look at my IRA right now. And I reminded him that Eric so brilliantly had recommended that we look at this tool called a buffer annuity. And we actually had just sort of locked the gains in January, which was a great time to be doing all of that. And we have a 20% downside protection in that particular tool. And what made me really laugh is that Mike's response was, I'm going to go scoreboard my friends at work. And I don't think he said those exact words, but that is essentially what he said. And I had a moment where I was like, this is really cool. It's kind of fun to be in that space. But I also think about it in terms of, we've been steadily building the cash value in our whole life policies really since I was 21 years old. So more than 20 years at this point. And when I look at that coupled with the market can be doing whatever it is doing. And in our regular investment accounts. And it doesn't terrify me, in part because I know what the math looks like, but also because there's a substantial portion of my portfolio which is unaffected by everything that's going on right now. And so, if I've got all that, then I have access to all of that. And this takes a dip, and I can stay in that long-term mindset in a very different way than if all of my money was at risk.
Yeah. Well, and it goes back to this idea that growing wealth is actually kind of boring. it's not supposed to be exciting. It's supposed to be kind of one foot in front of the other, building it up, and then you kind of wake up 10, 15, 20
Stay
years later.
stable or you're gambling.
Correct, correct. The other thing I've noticed over the last couple of years of doing this is that Mary's household is kind of like a Taylor Swift song. Like whatever conversations you're having at home, everybody's going to hear about it later on, which is
True.
really kind of awesome. So,
True.
I don't know if that makes Mike like John Mayer or something, but whatever.
I do not. I kind of think he's better than John Mayer. I mean, he might say that John Mayer is a better guitarist, but I think Mike Lyons might be a better human. So
Yeah.
I'm gonna hold on to that one.
I've met Mike. I think he is a better human.
Yeah, hands down, right? Yeah, I do occasionally ask him after we have an episode where I say something about him. I'm like, oh, did I say that in a way that he's gonna find offensive? So I'll ask him, did you listen to the podcast? Are you upset? And he's like, no, I'm good. He's like, I'll let you know if you cross the line. So far, I haven't done it, but
Right.
there may come a day. There may come a day. So here's what I would say. I think for starters, understanding that you can put solutions in place that allow for a steadier march toward retirement and that help protect what you're doing through choppy markets so that you don't have to go, oh my gosh, I'm terrified. I can't spend any money once you are retired because you've already built a plan that allows for an easy solution in environments like this, either because your income stream is not correlated to the market at all because you've done the simulated pension and you've just wrapped guarantees around it, or because you've put a buffer in place against times just like this, a shock absorber for when things get bad. I think that's the key, is recognizing that there are strategies that you can employ beyond just, I have a diversified portfolio and there's a handbrake for the S&P that will allow you to get further faster. And that will really make sure that not only do you get further, but you stay ahead. You aren't going backwards. Just one more quick story. We did an analysis for a client of ours fairly recently, and we looked at the strategy that they were pursuing when they first started working with us versus the strategy they have now. And we measured how much money could they lose out of their portfolio the day they retire. And at a minimum, they would still have the income they were going to have before they ever met us and put any of the strategies in place. And it was like $4.5 million.
It was amazing.
And those are the moments that I look at this and say, look, if you do nothing, you might be fine. But if you're willing to look at things in a new, creative way and say, what does the data actually tell me I should do? We got to get that writer in control as we go through here. You can put yourself into a position where you can take some pretty heavy hits and you're still in a better position you would have been in if everything went right, doing things the conventional way.
Well, and I think at the end of the day, it's if you don't believe that the elephant exists, then you have a problem. If you understand that the elephant exists and you have the ability to put blinders on it so that you're in more control, then you become a much more powerful rider because you're managing that risk before you have to take it, before you have to deal with it in the moment. If it's the first time you've seen it and the first time you're experiencing it, it's hard to manage because you're fighting both ends of your brain, and that's usually not a winning strategy.
No, for sure not. Sometimes I actually think that some of these conversations are easier for people who have been told that they're emotional their entire life because they already know they have a problem. So they're looking for a solution. Whereas people who have not been told that think they're very rational, analytical human beings frequently don't recognize when emotion is hijacking them. And that's probably like the one advantage I ever get for being an emotional creature right there.
Likewise. Yeah. At least I know it's there, right?
Right. So I know I need to do something with it. But, I think if I could offer any kind of parting words on any of this, if you don't deal with the problem is still there. My mom used to tell me not to decide is to decide. Just think about that one for a little bit. You have the ability to make some serious changes to how your portfolio is going to handle what happens in markets like this. And it is, to your point, Eric, having uncorrelated assets that are not connected to the market. And the best way that you can do that if you are insurable is through a permanent whole life insurance policy as a complement to what you are doing with the investments. It is never supposed to be an either or choice. What we are looking for is always the and And I think one of the things that is abundantly clear to me right now, kind of in this moment in time that we're in, is that the gap between the haves and the have-nots is getting wider. And so if I can employ a strategy that allows me to weather spots like this and keep chugging along and moving forward, but it allows me to safely spend more of my income and also create something for the next generation that is moving away from that scarcity and fear-based mentality into a space of abundance and making a difference, not just in my life, but in my children's lives while I'm alive and in theirs after I'm gone. And that to me is probably more important than the money for the sake of money. It's always to me about money for how it changes your reality.
%. Where can they find you, Mary?
At The Wealth Woman, wherever you use social media. What about you?
At Acorn Grove, wherever you use social media. Thank you so much.
See you next time.
Mary Lyons and Eric Alexander are registered representatives and investment advisor representatives of and securities offered through One America Securities Incorporated, a registered investment advisor, member FINRA, SIPC. Wealth Woman, Benchmark Income Group, and the Big Wealth Podcast is not an affiliate of One America Securities or the companies of One America, and is not a broker-dealer or registered investment advisors. The use of asset allocation or diversification does not assure a profit or guarantee against a loss. Investing involves risk, which includes potential loss of principal. Provided content is for overview and informational purposes only and is not intended and should not be relied upon as individualized tax, legal, fiduciary, or investment advice. All numeric examples and any individual shown are hypothetical and were used for explanatory purposes only. Actual results may vary.